This is ETF Edge. Once again, three of the best people in the business are joining us today. Ed Rosenberg from American Century, Todd Rosenbluth from CFRA, Simeon Hyman from ProShare. Simeon, let me start with you. It's Amazon Prime Day tomorrow. You have two retail ETFs that have done really well this year, but I want to get your thoughts on Amazon's Prime sale. There's reports out there we could be seeing 40% increase year over year for them. It's going to be quite a day, but other people are out there as well trying to do the same thing, including their competitors. What do you see right now for the retail landscape?
Look, the acceleration driven by the pandemic is well in hand and likely to continue. We saw a hockey stick in Q2. There was almost a 50% increase in online penetration overall. By the way, that was only from 11% of total sales online at the end of the year to 16% in Q2. A hockey stick, but earlier than people think. Here's why that uptick and that acceleration is likely to continue to be sticky and reflected both in Amazon and some of its key competitors. One is penetration across previously underpenetrated areas, like grocery. It may not be the hugest thing on Prime Day, but it's an important indication of what's going on here. There was almost no grocery even going into the end of last year, like 3% of total retail sales. That's now quadrupled. And so things that people never bought online, they're buying online now, and I think Prime Day is going to see an acceleration of that. From competitors, you see something interesting, too. There's stickiness. 70% of Chewy's business is subscription. So, a bunch of that uptick that they got in Q2 is likely to be sticky because they have ongoing relationships. And even in Etsy, 15% of Q2 was masks. So that's a very flexible platform. And as they've now entered the S&P 500, you can be sure they're going to try to convert those extra eyeballs into greater share of wallet and more mainstream opportunities.
Simeon, Todd, what impresses me is just the breadth of availability for retail ETFs that you could have. And I mean, I'm talking about retail, the business retail. I don't mean retail trading ETFs. Besides Simeon's, we'll discuss in a minute, the ONLN, the online retail ETF. There's also his long online short stores one. There's the S&P Retail Index. There's the S&P Retail ETF, XRT, which is more of an equal weight index. They're all doing well this year, although his strategy, Simeon's particular strategy of CLIX, of going long online and short stores is up 82%. So it's quite a move here that we've seen. It seems like it's been a successful strategy this year, Todd.
It certainly has. I mean, and Amazon is the juggernaut within the consumer discretionary space. Simeon talked about how it's gaining share and online spending is gaining share. Amazon is a 24% weighting in the ProShares online retail ETF, ONLN. It's about a 2.5% weighting within a competitor or peer ETF from Amplify, iBuy. What's interesting, actually, is Fidelity has the largest weighting. Fidelity Consumer Discretionary ETF, FDIS, has more than 30% of its exposure to just Amazon. So, again, investors should know what's inside their portfolio, and it might surprise you how heavy the weighting in Amazon has grown, given how well the stock has performed this year.
And I think the important here is you really have a wide choice here, like the S&P Retail Index, RLX, that's up 45%. That's essentially a market cap weighting of what's in the retail part of the S&P, but XRT is up 18%. That's like an equal weight. Simeon's ProShares online retail, ONLN's up 89%. So Simeon and Ed, weigh in if you have some thoughts here on retail. I'm just hitting up Simeon here, but it seems like purely online actually would have been the perfect play for this year, although your strategy of long online and also shorting some stores, CLIX, in that particular strategy, also has done well. It's up 82%. So it's basically online is where you want to be at this point.
No, I think that's right. But both sides are important. So the increasing penetration of online and the other side of the coin, the retail apocalypse, as people focus on, is important too. And, here one of the takeaways is one of the key points to observe is that it's not just the increase in the share of the wallet online, but the profitability thereof that we just talk about a lot. We talked about it a half hour ago on air, but Walmart has grown to be the number 2 player. So you say to yourself, okay, maybe this distinction doesn't matter anymore. But if you look at profitability, their reward has been declining margins. And meanwhile, Amazon's margins have doubled over the same time period. So there are real hurdles even for the select brick and mortar folks that are making a decent go of it online. And your observation is spot on. What we found in the performance of ONLN, which is long only, and then Clicks, which is 100 cents long and 50 cents short brick and mortar, you've actually gotten like over 90% of the long only returns with 50 cents short with Clicks. So we're really proud of that opportunity, offering you both sides of the trade and the spread trade as well.
And
Ed,
Bob, if I can add,
you want to weigh in here? And
yeah,
go ahead, Ed.
I mean, you see it, Bob. Where you're seeing it too is with active managers. I mean, if you look at one of our funds, Focused Dynamic Growth, within the last quarter, Amazon became the largest holding in the fund. So if you look at the 930 top 10 holdings, it's almost 9%, and it's been on the growth trajectory in the portfolio is going up. And so I think even the active managers recognize that in the retail space, Amazon is the play right now. And I think the other thing they're looking at is the downstream impact of something like an Amazon. Because if you're buying online, where else does that impact? Right? And if you notice, and just using that fund as the example, one of the top 10 holdings is also MasterCard. And I think you're seeing some of the downstream impact of people using credit cards and seeing growth in that area as well, whether it's MasterCard, Visa, American Express, to take advantage of what's happening with Amazon and Prime Day, as well as being online.
Good point. Very good point. I want to move on. We've got a couple topics I want to hit today. Todd, I want to talk to you about dividends briefly. And guys, feel free, Simeon and Ed, feel free to weigh in here. We have all been worried that dividends would be cut down dramatically this year. And it seems like the worst case scenario hasn't happened. Todd, I'm wondering if you could comment on that. And this is good news for Simeon. He has the Dividend Aristocrats ETF, NOBL. We'll talk about that in a moment. But Todd, what's the status of dividends, and are we out of the woods on worries that we might see a lot more significant dividend cuts later in the year? Is that off the table?
The second quarter of 2020 was the worst. We actually saw twice as many companies either cut their dividend or suspend their dividend than a more positive impact of either initiating or raising the dividend. In the third quarter of 2020, and this is using data from S&P Dow Jones Indices, we saw 3 times as many companies raise or initiate the dividend and took that negative action. We've seen specifically actually some more technology and growth-oriented companies like Accenture, Microsoft, Texas Instruments. These are all companies that raised their dividend in September. We're seeing a number of technology companies raise the dividend. You mentioned Simeon's Dividend Aristocrats. That actually has a low weighting within technology, but they have a ProShares S&P Technology Dividend Aristocrats, TDV, which focuses on companies that have raised dividends for the last 7 years in the technology space. And there's a lot of great companies there. We also see hefty weightings within Vanguard Dividend Appreciation, VIG, and WisdomTree's U.S. Quality Dividend Growth Fund, that's DGRW. These are more forward-looking or shorter time period of a look back, and technology companies, as of late, has really been driving the dividend growth story, and I think that's something we're going to see more of heading into the fourth quarter.
Well, the important thing, and that I'm hearing from you, is second quarter was the worst. And I saw this from the S&P. It doesn't seem like we're seeing any increase. Indeed, some people have reinstated the dividend. That's kind of what I'm trying to get at here. There was a real scare 5 or 6 months ago.
Yeah.
That seems to have passed now.
Bob, you have to dig into it, though. I think it's true at the broad market level that dividends have always been more resilient than price, and that's one of the key advantages of being a dividend-oriented investor. If you look year to date, to Todd's point, we calculated about 15% of dividend payers have cut this year, so it's not trivial, but it's not an unmitigated disaster. But if you split it up, the vast preponderance of those cuts are from low-quality companies, whether they're levered companies, whether they're companies with high dividend payout ratios, high dividend yields, low credit quality. Right. But if you look at the good quality stuff, You mentioned the S&P 500 Aristocrats, the index that our ticker NOBL follows.
Yeah.
One company is cut year to date, so there are definitely haves and have-nots in the dividend resiliency equation.
Right. And Ed, one of the lessons we constantly point out about the dividend business is that in general, not all the time, but in general, you want to buy into companies that are consistently raising their dividends over many years, which was the Aristocrats' ideology or methodology, rather than buying companies that simply pay a high dividend where you could have a risk that the dividend could be cut. Would you agree with that? That generally, if you're into dividends, that's probably the way to go?
So I would agree with that, with one quick exception. The only exception is you also want to look at the other side of the ledger, the debt. Are companies using debt to continue to raise that dividend so they can stay within, whether it's indexes like Noble or just be quality overall, in the eyes of the investor? So you have to look at the company as well and how much is their debt increasing just to sustain that dividend. But overall, companies that are good quality companies, as Simeon said, that continue to raise their dividend without taking on debt, without cutting in environments like we just went through, generally they can be good companies to go for. But you really do want to look in what's happening with those companies just to make sure that they're not increasing any of their risk, just to make sure that dividend continues to pay.
Good point. Good point. Very good point. I want to move on and talk about consolidation in the industry. This is something we talk about all of the time. We saw last week Morgan Stanley announced it was buying Eaton Vance a week after closing the E-Trade deal. It's quite a move for Morgan Stanley, rather aggressive. I guess, and I'm going to throw this out to all three of you. You're all involved in this industry. People kept messaging, why is this deal happening? And I kept saying, one, where actively managed funds are losing clients that are out there. Number two, ETFs are putting downward fee pressure on the overall industry, and that's pushing people towards more consolidation. And finally, to survive, funds need to get more assets under management. It's quite simple. I wonder, Todd, you're an observer of this business. Are we going to see the number of E-Trade, online brokers is pretty small already. I don't know how much consolidation we're going to have anymore in that area, but there's still some financial services firms that are out there. Do you anticipate more consolidation, and why?
So we do. We think there's going to be more consolidation among the asset managers for the reasons you touched on. Scale wins. You need to be able to compete at a aggressive enough price to get investor attention. At some point, the asset managers are going to need to lower their fees for mutual funds in order to realize that money is shifting towards ETFs. But what's interesting to me about this deal of Eaton Vance is Eaton Vance does not have an ETF presence. This is an ETF show. You would think that they would want to be a part of the growing party of $5 trillion and counting of ETF assets. Eaton Vance doesn't have exposure to that. Morgan Stanley doesn't have exposure to it. The sweet spot for Eaton Vance is twofold. They've got ESG-oriented mutual funds through Calvert, and they've got municipal bond mutual funds that are held more by mom-and-pop investors that are relatively loyal. But it's a bit surprising that Morgan Stanley is just not going where the puck is headed towards the ETF industry.
Why do you think that is, Todd or Ed or Simeon? Do you think it's a tactical error on their part?
Well, I was going to give them one more piece of credit. I think Parametric could be a little bit of an interesting piece of this puzzle, too. I'll be curious to see how they can scale that, because that's a nice little differentiated business, even though it's housed in, a legacy mutual fund complex. And that's always been a nice offering on mass affluent and high net worth platforms. So that might be a little bit of hidden opportunity for them to scale that up a little bit.
Okay.
Yeah.
Good point.
And Bob, I'll add that. I'm
Go
sorry.
ahead.
You just don't need ETFs now if you're Morgan Stanley. If you think about it, the shops that might get eaten up to create assets for them, like an Eaton Vance, that didn't have them. But as you go forward, a shop like Morgan Stanley would have the ability to launch ETFs when they want, because they have a natural distribution arm, whereas someone like Eaton Vance, who they bought, doesn't. And so it can create
and why haven't they done that already? I mean, J.P. Morgan did it. Schwab did it. Why is Morgan Stanley sort of ignoring this?
I mean, I would say that, as you go with those big companies, there's a lot of hurdles to get through to launch any new product. and any new structure type. And I think it's just a time for them just to get through all of their hurdles to make sure that they check all the boxes. Who knows? But I suspect you're going to see not just companies like Morgan Stanley, but a lot more firms launching ETFs that haven't in the next 5 years than you saw in the past 5 years.
Yeah. Okay, I want to move on. We've only got a couple minutes left, but I want to touch on the elections because I keep getting a lot of email questions about how it's affecting the ETF business. One of the hottest ETFs of the year is the solar ETFs, TAN. It's up 150%, something crazy like that this year. And the obvious reason is a lot of people, you see the growth in the last couple of months, the obvious reason is there is a belief that a clean energy agenda, should Biden win, would be very much on the overall agenda here. And I think that's the main reason it's moving. I just want to ask any of you, all three of you, very briefly, is there any area, should Biden win, is there any area that you think it would be particularly in the ETF business? We don't have a long time for a long discussion. This will happen in the future, but just give me something quick here on where you think might move. Should Biden win the presidential race?
So, Bob, if I can jump in here, I would say the first places they've talked about, obviously, if Biden wins, is infrastructure. And at the high-level sector, you're either going to buy infrastructure or look to industrials to take advantage of that once they win. And if it's a blue wave, I think you'll see investment across the board in infrastructure, which will lead to industrials, which is where most of those companies lie, start pushing forward with better, prospects and better earnings.
I'm going to second that motion and do a shameless plug for ticker TOLZ, which is our infrastructure ETF. And in that ETF, we actually hold the owners of the infrastructure assets. So they have stable cash flows and a ticket to extra to an uptick in spending. So you're not sort of left holding the bag just in case we're wrong.
So since I'm not working for an ETF provider, I'll just add Global X has a U.S. infrastructure development ETF, PAVT, which is another strong competitor in the infrastructure space.
All right. We went over a lot, guys, and you all were terrific, but that's why we have you on, because you're the best out there. I want to thank everybody for joining us here. Ed, Simeon, and, of course, Todd, a regular on our show here. And remember, you can catch all of our videos on our website, etfedge.cnbc.com. And don't forget the podcast where Kirsten Chang, my producer, and I go into a little more detail on the topics today